Chapter 1, The Intelligence Trap, Why Your Brain is Keeping You Poor. What if everything you thought made you good with money is actually the reason you're struggling? Stick around, because in the next few minutes, I'm going to show you something most financial experts will never tell you. That intelligence, education, and even financial knowledge can actually work against you when it comes to building real wealth. And before you click away thinking this doesn't apply to you, one number? 70%. That's the percentage of lottery winners who go completely broke within 5 years of their windfall. These aren't people who didn't have money. They had millions and still lost it all. So if raw money can't fix the problem, what can? Let me introduce you to someone I'll call Daniel. Daniel was 38. Master's degree in economics. Earning $95,000 a year at a financial consulting firm. He literally helped companies manage money for a living. But Daniel had $600 in savings, $31,000 in credit card debt, and a knot in his stomach every time his phone buzzed. Pause right there. A man who understood compound interest, who could read a balance sheet, who advised corporations on financial decisions, was himself quietly drowning. How does that happen? Here's the answer. Knowledge and behavior are two completely different things. Knowing what to do and actually doing it are separated by something that has nothing to do with intelligence. They're separated by psychology, by emotion, by the invisible stories we carry about ourselves and money that run on autopilot beneath every financial decision we make. Daniel knew he should save. He knew the math on compound interest better than most people know their own phone number. But every time he got a paycheck, a voice appeared. Not loud, subtle, almost reasonable. That said, "You've worked hard. You deserve this. You'll start saving next month when things settle down." Next month. That phrase has stolen more wealth from smart people than any market crash in history. Quick check right now. How many times in the last year have you told yourself you'd start something financial next month? Count the months. Then multiply by whatever that delay cost you. That number is the real price of next month. Here's where it gets uncomfortable. Smart people are actually more vulnerable to specific financial traps than people who've never studied finance at all. The reason is something psychologists call overconfidence bias. When you know a lot about something, your brain starts believing it knows more than it actually does. You read a few investing books and suddenly you're convinced you can spot market trends that professionals miss. You understand interest rates, so you tell yourself you'll pay off that credit card balance strategically. You know budgeting theory so well, you genuinely believe you don't need to write one down. You'll track it mentally. And then you don't. This isn't weakness. This is how human brains work. The more competent we feel, the less urgency we feel to act. Psychologists call this the planning fallacy. The certainty that our future self will be more disciplined, more organized, more financially responsible than our present self has ever managed to be. Here's an analogy. Imagine a doctor who knows everything about the dangers of smoking. Every study, every statistic, every cellular mechanism by which cigarettes cause damage. And yet, they smoke. Does their knowledge make them healthier? Of course not. Because behavior isn't driven by knowledge alone. It's driven by emotion, habit, and the psychological environment we operate in daily. Your financial life works exactly the same way. When we stopped looking at Daniel's spreadsheets and started looking at his story, something different emerged. Daniel grew up in a household where spending money was how his family expressed love and celebration. Every achievement was rewarded with a purchase. Every difficult emotion was soothed with something bought. Daniel hadn't learned to manage money. He'd learned to use money to manage feelings. And no economics degree teaches you how to unlearn that. Pause here and think about your own story. What was money like in your home growing up? Was it tight and stressful? Spent freely? Never discussed? Whatever you experienced shaped the financial decisions you made last week. Whether you realize it or not. There's one more trap that catches smart people specifically. Analysis paralysis. The more information you have, the harder it becomes to act. A person with no knowledge of investing might simply open a basic index fund and start contributing. A person who has read extensively might spend 3 years researching the perfect portfolio and invest nothing, while the first person's money quietly compounds in the background. Imperfect action taken consistently beats perfect planning done indefinitely. Every single time. Daniel eventually made 3 changes. He automated savings on payday before he could reason his way out of it. He deleted every shopping app from his phone. And he tracked his net worth monthly. Just one number, giving his intelligent brain something productive to focus on. 18 months later, $11,000 in savings. Credit card debt down to $14,000. Same income. Different behavior. Completely different trajectory. Here's the mindset shift to carry into every chapter of this series. Stop asking what you should do with money. You probably already know most of the answers. Start asking instead, why don't I do what I already know? That question is where the real work begins. Not in becoming smarter, but in becoming more honest about what's actually driving your decisions. Your action step tonight. Write down one financial thing you already know you should be doing, but aren't. Then write down what's actually getting in the way. Name it. Because named obstacles are manageable. Unnamed ones run your life forever. In Chapter 2, we go deeper into the trap that quietly ensures that no matter how much you earn, you always seem to need just a little more. Don't skip it. If this already has you thinking differently, hit like and share this with someone smart in your life who somehow never seems to get ahead. They need to hear this more than they know. Chapter 2, Lifestyle Creep, the Invisible Cage of Earning More. Is it possible that earning more money has actually made your financial situation worse? Not worse in a dramatic way. No sudden crisis. Just a quiet feeling that no matter how much more you earn compared to 5 years ago, you have less breathing room than you used to. Less savings. More expenses that feel essential, that somehow didn't exist before. If that resonates, you're experiencing what economists call lifestyle creep. And it is one of the most insidious financial forces in existence. Precisely because it never feels like a problem while it's happening. It just feels like progress. Comment 1 below if your expenses have grown every time your income grew. Comment 2 if you can't remember the last time a raise actually changed your savings rate. I read every comment. And I promise, this room is more crowded than you think. Let me tell you about Vanessa. 36 years old. Senior product manager at a tech company. Her income had grown from $55,000 to $118,000 over 8 years. She had worked incredibly hard for every dollar. And yet, Vanessa was saving less money at $118,000 than she had been at $55,000. Not proportionally less. Actually less. In raw dollars. At $55,000, Vanessa drove a used Honda. Lived with a roommate. Brought lunch to work most days. Saved $400 a month because $400 felt meaningful and necessary. At $118,000, she leased a new Audi. Had her own apartment in a pricier neighborhood. Ate out regularly. Had a gym membership she rarely used, a meal kit subscription that expired in her fridge, and 3 streaming services she paid for out of guilt about canceling them. Her expenses hadn't grown because she was reckless. Each individual upgrade had felt completely reasonable at the time. She could afford it. She deserved it. She'd earned it. Pause right here. Think about the last 3 years of your own income. Have your expenses grown in proportion to your earnings? Can you point to meaningful wealth you've built from raises or promotions? Or has the money simply expanded to fill the available space? Here's the psychological mechanism at work. It's called hedonic adaptation. Your brain is wired to normalize new experiences rapidly. The excitement of a new car fades within weeks. The satisfaction of a nicer apartment becomes the baseline within months. And once something becomes your new normal, going back feels like deprivation. Even if back was a perfectly comfortable life you were genuinely happy in not long ago. This is not a character flaw. This is human biology operating exactly as designed. Here's the counterintuitive truth that changes everything. The path to financial freedom is not earning more. It's keeping more of what you already earn. And the single most powerful concept to understand is what I call the wealth gap. Your wealth is not determined by what you earn. It's determined by the gap between what you earn and what you spend. A person earning $50,000 and spending $38,000 is building wealth at a rate that a person earning $120,000 and spending $118,000 will never match. The number on your paycheck means almost nothing. The gap means everything. Quick check. How much of your monthly spending is driven by what genuinely makes your life better versus what feels necessary to maintain a certain image of yourself? Be honest, even if it's uncomfortable, especially if it is. Now let's talk about status spending versus stealth wealth. Status spending is visible. The car in the driveway, the brand on your wrist, the neighborhood your address comes from. It performs success, but it consumes wealth rather than building it. Stealth wealth is invisible. The index fund growing quietly in the background. The fully funded emergency account that lets you sleep soundly through economic uncertainty. Stealth wealth doesn't photograph well, but it creates something status spending never can. Options. Freedom. The ability to say no to things you don't want, and yes to things you do, without checking your balance first. Here's the rule that makes the difference. The moment you receive any income increase, before adjusting a single lifestyle expense, automate at least 50% of that increase directly into savings or investments. Not after you've accounted for new expenses. Before. If you get a $500 raise, $250 goes to savings automatically on the first payday. You never see it. You never adapt your lifestyle to include it. The other $250 is yours to enjoy guilt-free. Because you already paid your future self first. Vanessa made 2 changes. She stayed in her existing apartment for 1 more year instead of upgrading, and she redirected her next performance bonus entirely into her investment account before she imagined what else to do with it. 1 year later, she had $22,000 invested for the first time in her life. Her lifestyle hadn't suffered in any meaningful way, but her relationship with her future had changed completely. Your action step. Pull up your last 3 years of income. Compare it honestly to your savings over the same period. Did your savings rate grow with your income? Or did lifestyle absorb every raise? Then commit right now to what percentage of your next income increase goes directly to your wealth gap, before your lifestyle sees a single dollar. In Chapter 3, we go after the debt that smart people accumulate differently than everyone else. Debt dressed in the language of investment and opportunity. And it is far more dangerous than a credit card balance. Stay with me. Share this with a high earner in your life who seems to have nothing to show for it. Understanding why is the beginning of changing it. Chapter 3. Smart Debt, Dumb Decisions, How Intelligent People Borrow Their Way to Broke. Here's something nobody talks about. High earners, educated professionals, financially literate people don't get into debt the same way everyone else does. They don't swipe credit cards impulsively at the mall. No. Smart people get into sophisticated debt. Debt wrapped in the language of leverage, investment, opportunity, tax strategy. And it is, dollar for dollar, far more destructive than any credit card balance, precisely because it is so easy to justify. Let me tell you about Kevin. 44 years old. A practicing attorney, earning $160,000 a year. Beautiful home. Private school for his kids. Annual international vacations. From the outside, success looked exactly like it was supposed to look. Kevin had $4,200 in savings and $287,000 in non-mortgage debt. A home equity line used to renovate the kitchen. A business loan for a side venture that had never turned a profit. 2 car payments. A personal loan to cover a tax bill he hadn't planned for. And $41,000 across 4 credit cards. Each accumulated gradually, through what Kevin described as necessary expenses and temporary situations. Each individual debt had felt justified at the time. Reasonable. Even smart. Pause here. How many of your current debts were temporary when you took them on? Here's the most dangerous financial phrase in the English language for smart people specifically. I can afford the payments. Payments are not affordability. Payments are a monthly fee you pay for a decision you can no longer undo. When you say I can afford the payments, you are not measuring whether you can afford the thing. You are measuring only whether the debt fits into your current cash flow. And that is an extraordinarily low bar. Because almost any debt, even catastrophically unwise debt, can be structured with payments small enough to technically fit into a high income. Quick check. Add up your monthly non-mortgage debt payments right now. All of them. Now ask yourself, if that same dollar amount were going into investments every month instead, where would you be in 10 years? Run that number. Let it sit with you. Now let's talk about the 3 traps that catch smart people most often. Trap 1. The lifestyle mortgage. Borrowing against your home equity not for genuine emergencies, but to fund consumption that feels too important to delay. Kitchen renovations, private school tuition, vacation upgrades. The danger is critical. You are converting consumer spending into secured debt against your most important asset. If your income changes, you are not behind on a credit card. You are at risk of losing your home to fund a kitchen island. Trap 2. The entrepreneurial debt spiral. Smart people are drawn to business ideas. Their confidence in their own intelligence makes them optimistic about their own ventures. And that optimism leads them to fund businesses with personal debt, often far longer than the data justifies. Kevin's side venture had been losing money for 3 years. But because he'd invested his own credibility alongside his borrowed capital, he kept funding it. Not because the business warranted it, but because admitting failure felt like admitting something about himself he wasn't ready to face. Debt tied to ego is the most expensive kind that exists. Trap 3. The investment loan. Borrowing money to invest in assets you're convinced will outperform the interest rate on the loan. Sometimes this works. But when it doesn't, you still owe the debt in full, while watching your investment decline. Borrowed money removes your ability to wait out volatility. And in investing, patience is the most valuable thing you have. Debt eliminates it entirely. Here's the 3-question test for any debt decision. Question 1. Does this debt directly generate income that exceeds its total cost? Not could it. Does it? With reasonable confidence. No. It is consumption debt. Regardless of how sophisticated the justification sounds. Question 2. If my income dropped 40% tomorrow, could I still service this debt without catastrophic consequences? Any debt that requires your current income level to sustain is fragile debt. And fragile debt in an uncertain economy is a trap waiting to close. Question 3. Am I taking this debt because it's genuinely the best option? Or because it allows me to have something now that I'm not yet in a position to afford? Our intelligent minds are extraordinarily good at generating sophisticated justifications for decisions that are fundamentally emotional. Kevin stopped the flow of new debt entirely for 24 months. He sold the underperforming business, refinanced his home equity line into a structured payoff plan, negotiated balance transfers on his highest rate cards, and redirected $3,500 a month that had been disappearing into debt service, into savings and investments. 3 years later, non-mortgage debt under $60,000 and falling, $28,000 in savings, a retirement account he's actually contributing to for the first time. Same income. Completely different financial architecture. Your action step. Run every current debt through the 3-question test tonight. Be ruthlessly honest. Identify which debts are genuine investments, and which are consumption dressed in sophisticated clothing. Then make one concrete decision. One debt you will stop adding to. One payment you will redirect the moment it clears. In Chapter 4, we talk about why smart investors make consistently terrible decisions, even when they know exactly what they should be doing, and the one cognitive bias that has cost investors more money than any market crash in recorded history. Don't skip this one. Drop the debt trap that resonated most with you in the comments. Your story might be exactly what someone else needs to hear today. Chapter 4, Why Smart Investors Lose, the Bias That Destroys Wealth. Here's a stat that should stop you cold. Over a recent 20-year period, the S&P 500 returned an average of 9.5% per year. The average individual investor, over that same period, returned just 3.7%. Same market, same stocks, same opportunities. Where did the other 5.8% go? It didn't vanish into fees or fraud or bad luck. It was destroyed by behavior. By the perfectly predictable, thoroughly documented, psychologically driven decisions that investors make when their emotions get involved with their money. And smart investors, I have to tell you this honestly, are among the worst offenders. Pause here and answer honestly. When markets dropped sharply the last time, what did you feel? Did you check your portfolio obsessively? Did you sell anything? Did you consider it? Your answer tells you more about your investment future than any knowledge of financial markets ever could. The culprit has a name. Loss aversion. Discovered by psychologists Daniel Kahneman and Amos Tversky, it describes the fact that losses feel approximately twice as painful as equivalent gains feel pleasurable. Losing $1,000 hurts about twice as much as gaining $1,000 feels good. This asymmetry, extraordinarily useful for our evolutionary ancestors, is catastrophic in financial markets, because it causes investors to hold losing investments too long, hoping to avoid locking in a loss that already exists, and sell winning investments too early, securing the good feeling of a gain before the market can take it away. Both behaviors destroy returns. Here's the bias that hits smart investors specifically. Overconfidence. When you read extensively about markets, when you understand economic cycles, when you follow financial news, your brain develops a dangerous sense of predictive ability that the evidence simply does not support. Let me tell you about Raymond. 47 years old. Former engineer turned financial analyst. Genuinely brilliant. He'd managed his own investment portfolio for 15 years. Spent weekends reading earnings reports and analyzing sector trends. Considered index fund investing lazy. And genuinely believed his research gave him an edge. Over those 15 years, Raymond's portfolio underperformed a basic S&P 500 index fund by an average of 3.2% per year. 3.2%, compounded over 15 years, represents hundreds of thousands of dollars. Gone. Not to bad luck. Gone to the cost of overconfidence. The trading fees. The tax drag from frequent transactions. The wrong calls made with great conviction. And the inability to simply sit still and let compound interest work. Raymond knew more about investing than 99% of people. And that knowledge had cost him dearly. Quick check. Have you ever made an investment decision based on strong conviction about a specific stock or sector? How did that conviction perform against simply holding a diversified index fund over the same period? Most people have never run this comparison. Run it. The results are usually humbling. Here's another bias that destroys wealth quietly. Recency bias. The overwhelming tendency to believe that whatever happened recently will continue to happen. When markets rise, recency bias makes investors pour money in near the peak. When markets fall, it makes investors sell near the bottom. Buy high, sell low. The exact opposite of rational behavior. And almost universal in practice. And here's the cruel irony for smart people specifically. The more you know about economics, the more sophisticated your reasons for panicking become. An unsophisticated investor might just feel scared and sell. A sophisticated investor will construct an elaborate, internally coherent narrative, backed by real data, for exactly why this time is different. But the outcome is identical. Selling at the wrong time. Missing the recovery. Destroying the returns that compound interest would have quietly built, if left undisturbed. Here's the behavior gap strategy that Raymond eventually adopted. 4 rules. Rule 1. Choose your allocation and automate everything. Decide what percentage belongs in stocks versus bonds based on your genuine risk tolerance. Not your theoretical tolerance in good times. Your actual tolerance when markets are down 30% and every headline suggests things are getting worse. Then automate contributions so no monthly decision is required. Decisions are where emotion enters. Automation removes the door. Rule 2. Set a review schedule and honor its limits. Check your portfolio quarterly. Not daily. Not every time markets make the news. Studies show investors who check daily make significantly worse decisions than those who review quarterly. The data is that clear. Put the phone down. Rule 3. Write a personal investment policy statement before markets move. Articulate in writing what you will and will not do when volatility arrives. When panic comes, and it will, that written statement becomes your rational self speaking to your frightened self across time. Follow the policy, not the feeling. Rule 4. Measure yourself honestly against a simple low-cost index fund. Annually. Because the data is the most powerful antidote to overconfidence that exists. Raymond moved 80% of his portfolio into 3 low-cost index funds. Set quarterly reviews. Wrote his policy statement. In the 2 years that followed, including one significant market correction, he stayed the course. His returns, doing almost nothing, exceeded his average annual returns from 15 years of active management. He told me, the hardest part wasn't understanding the strategy. The hardest part was accepting that doing less was actually doing more. Your action step. Write your personal investment policy statement tonight. Even 3 sentences. What you invest in. How often you'll review it. What you commit to doing when volatility arrives. Then the next time markets move dramatically, read that statement before you do anything else. That pause between the feeling and the action is where wealth is protected. In our final chapter, we bring everything together. The single most important shift that separates smart people who stay broke from those who build lasting wealth. It has nothing to do with strategy. It has everything to do with identity. Don't miss it. Like this if Raymond's story made you reflect on your own behavior. And tell me in the comments, active manager or passive index investor. Where do you stand? Chapter 5. The Identity Shift. Becoming someone who actually builds wealth. Here's the most important question of this entire series. And I want you to answer it right now. Before I say another word. Who are you, when it comes to money? Not who you want to be. Not who you're trying to become. Who do you actually believe yourself to be, at the deepest level, when no one is watching, and a financial decision has to be made? Because here is the truth that every previous chapter has been quietly building toward. Your financial behavior will never consistently outperform your financial identity. You can know every strategy. Read every book. Understand every concept we've covered. And if your core identity is someone who struggles with money, someone who's not really a saver, someone who's smart but just not disciplined enough, you will unconsciously make choices that keep that identity true. Every time. This is not philosophy. This is neuroscience. Your brain is wired to seek consistency between your self-concept and your behavior. When you act in ways that contradict your identity, it creates psychological discomfort called cognitive dissonance. And your brain resolves that discomfort, not by changing the behavior, but by changing the story. I deserve that purchase. I'll make up for it next month. Everyone struggles with this. Smart people are especially good at writing those stories, because they have the intelligence to make them sound completely reasonable. Let me tell you about Isabel, 39 years old. A gifted writer earning $88,000 a year. Articulate, creative, self-aware. And chronically, reliably broke. Not dramatically broke. Functionally broke. The kind where the paycheck arrives, the relief is immediate, and within 10 days the anxiety returns. Isabel had read personal finance books. She understood the concepts. She'd started budgets, made plans, set savings goals, and abandoned them. Every time. Not out of laziness, but because deep in her identity she carried one story. Creative people aren't good with money. Artistic types aren't built for financial discipline. That kind of structured thinking isn't really me. These weren't facts. They were stories. Inherited from a culture that romanticizes the struggling artist. Reinforced every time she saw a financially successful person and quietly thought, that's just not who I am. Pause and think about your own story. What identity have you assigned yourself around money? What have you decided is just not you? Because whatever you've decided isn't you, your behavior will faithfully honor that decision. Every single month. Here's the shift that changed everything for Isabel. It wasn't a goal change. It wasn't a strategy change. It was an identity change. And it started with 2 words. I am. Not, I want to be. Not, I'm trying to become. I am. She started saying, writing, declaring. I am someone who handles money with intention. I am someone who pays themselves first. I am someone who thinks long-term. Your intelligent brain just raised an eyebrow. I know. But the research behind this is serious. James Clear's identity-based habit research. Carol Dweck's decades of work on fixed versus growth mindsets. All of it points to the same mechanism. Behavior change that lasts begins with identity change, not the other way around. Most people try to change behavior first and hope identity follows. The sequence that actually works is change your identity first, even slightly, even tentatively, and behavior, seeking consistency with that new identity, begins to follow. Here's the identity architecture framework in 4 parts. Part 1. The identity statement. Write who you are becoming in the present tense. Not, I want to be financially free. I am someone who builds wealth systematically. Read it daily. The awkwardness you feel is your old identity resisting. Push through it. Part 2. The identity consistent action. Every day, take one action consistent with your new identity, no matter how small. Transferred $10 to savings? Identity consistent. Checked your net worth? Identity consistent. Declined an impulse purchase? Identity consistent. These small actions aren't primarily about the money. They're about casting votes for the person you are becoming. Every vote counts. Part 3. The environment redesign. Identity is fragile in hostile environments. If your phone is full of shopping apps, if your social circle normalizes overspending, your environment is actively working against your identity change. Delete the apps. Unsubscribe from promotional emails. Find communities where financial intentionality is normal and admired. Your environment is not neutral. It is either working for your new identity or against it. Part 4. The monthly identity audit. Once a month, review your financial decisions through one lens. Did my choices this month reflect the person I am becoming? Where did I act consistently with my new identity? Where did my old identity reassert itself? This is not self-punishment. This is self-awareness applied deliberately. And it compounds, exactly like interest does. Here's the full picture of why smart people stay broke. It is not a knowledge problem. In Chapter 1 we saw that intelligence without self-awareness creates overconfidence that paralyzes action. In Chapter 2 we saw that rising income without a rising wealth gap creates the illusion of progress while building nothing. In Chapter 3 we saw that sophisticated debt, justified by intelligent reasoning, can quietly bury even high earners under obligations they never saw coming. In Chapter 4 we saw that the same intelligence that generates investment conviction generates exactly the behavioral biases that destroy investment returns. And here in Chapter 5, the root. The reason smart people stay broke is an identity problem. The gap between who they know they should be financially and who they believe themselves to actually be. That gap is where every strategy goes to die. And closing it is the work that makes everything else finally stick. Isabel, by the way, is doing beautifully. Automated savings. A growing investment account. Still writing. Still creative. She didn't have to become someone else. She just had to let go of the story that creativity and financial discipline were incompatible. They never were. The story was just a story. Your final action step. Write your identity statement right now. I am someone who. Finish that sentence with the financial identity you are choosing. Not hoping for. Choosing. Read it tonight. Take one identity-consistent action today, even a small one, and then come back to this series from Chapter 1 and listen again. Because the second time through, you will hear things that didn't land the first time, because you will be listening as a different person. If this series genuinely shifted something in how you think about yourself and money, I have one ask. Binge it from the beginning. Share it with a smart person in your life who somehow never gets ahead and can't understand why. And subscribe with notifications on, because every week we go deeper into the psychology of wealth, the behavior behind financial freedom, and the identity shifts that make lasting change not just possible, but inevitable. Thank you for being here. You are not broke because you're not smart enough. You're here which means you're already doing the most important thing. You're looking honestly at the truth. Now go build the financial life your intelligence always deserved.